Thank you for tuning in to Mastering the Math of Business with Lauren Young. Today we're going to be talking about the most important scorekeeping tool in your business, and that's your P&L statement. Your P&L statement is a function of your income, i.e. your sales, minus your expenses. That becomes your net income. It is comprised of these core areas within every P&L statement, no matter whose you look at. There's going to be the sales component. Then you're going to have your direct costs, often referred to as cost of goods sold. That'll give you your gross profit. Then you come down, you got your selling, general, and administrative expenses. This is also referred to as overhead, non-operating. Non-operating costs are down here. The difference between these costs and these costs is your SG&A or your overhead exists to support the business, i.e. the business of generating the sale and converting that sale into gross profit. Your non-operating costs are those expenses that don't have any direct influence on any of this above. The opportunity is to understand the relationship between these so that you can in essence know where you're playing your game of business well and where you're struggling. Let's look at it from this perspective. When you step back and think about the role of management, the role of management is to maximize this number down here. That's the net income, also referred to as the net profit of a business. Your P&L statement is the tool that tells you how well management has done this. The one challenge with the P&L statement, it's always in arrears. In other words, you're always looking back at the results. It isn't a forward-looking document. It's a document that tells you what has happened. But it does enable you to isolate areas within the business that are causing you to make less money than you should. And this is how you can use it to position the business in the future by appreciating, particularly in the most recent months, even year, where there are problems or issues that cost you more money than they should. The way I like to think about the P&L statement is I like to think of it in terms of a scorecard or a scoreboard. So, for example, think about the last time you attended a sporting event. For me, it would have been an NFL football game. I love professional football. But just think how dull it would get over time if there wasn't a score being kept. If you didn't know where you were in the game, what period it was, what down, how many yards to go. If you didn't have these basic elements available to you during the game, you would quickly lose interest. And then think about the game of golf. Yes, there are some rounds where you wish there was no scorecard, but it's nice to know when you're doing better and which holes are you having consistent success in and which ones are you struggling in. Then you can isolate why and make the appropriate adjustments. Your P&L statement does the same thing for your business. So let's look at a scenario here. You've got a business that is gonna, one of two things are gonna happen. In fact, this is really, when it's all said and done, there's really two conclusions with a possible third option as it relates to why a P&L statement isn't performing as well as it should. One is sales are short. So in this scenario, missing sales by 8% puts a lot of pressure on the business to find ways to save money because they got less sales coming in to cover their expenses. The other way is expense management. In other words, expenses aren't being managed as tight as they are. So you've got a scenario where you're overspending on COGS, SG&A, and non-operating costs, and that has a negative impact on the bottom line. Or in the worst case scenario, you got both going on. And that's always a problem when sales are down and costs are up. That's always a great challenge. So let's look at what you need to know to be able to gauge this. Well, for one instance, you just need to know what you're working towards. And it really comes down to the big four numbers. In other words, how much do you want to sell? What's the gross profit off of those sales? How much are you going to hold on to out of that gross profit once you pay your overhead? And after non-operating is taken care of, what's left over? That's the net income. So you will need to know if you're missing your sales, how much are you missing it by? What's the percent? If you're overspending on COGS, SG&A, or non-operating, what are the overspends? And then with these 4%, you can gauge where your problems are. So for example, in this scenario, we've got an 8% sales miss. That means sales are going to be 9.2 million instead of 10 million. The plan is an 18% return on sales. And so if I hold my 18% goal, in other words, I want to make 1.8 million. So it's okay if I drop my sales as long as I hit my 1.8 million. So for me to be able to do that, because of this sales hit, that means I need to increase my operating margin such that I'm spending at least 1.6% less, or I've got roughly a 20% net income margin so that I can generate my 1.8 million in bottom line profit. That's how you overcome a sales miss. You overcome a sales miss by reducing costs faster than sales are going down. Now let's look and see what an expense problem looks like. An expense problem is really a function of spending more than you're planning to spend, and it's best looked at as a percentage of sales. But in this case, we want to appreciate what the impact is on our bottom line. So for example, in this dynamic with these misses, you're losing this much. So in other words, you're now spending $612,000 more in total than you planned to spend. That's a 6.1% hit against sales. So instead of making 1.8 million, you're now making something short of 1.2 million. That means you're returning just shy of 12% instead of 18%. The point here is you really can't dig yourself out of an overspend problem by increasing sales. Yeah, okay, this will reduce the percent here. But if you're overspending in your direct costs, selling more at a higher cost of goods sold doesn't translate into more net income. So the key is you've got to know where the business is struggling so that you can then intervene appropriately. And that's what your P&L statement does for you. It lets you know where the issues are and gives you what I like to call line of sight to what needs to be corrected. The call to action with this video is actually one of my rare ones, and that is the offer of a free assessment of your P&L statement. So if you go to businesscpr.com/F7, F7 is how you schedule the free assessment of your P&L statement. And what you'll get back is an assessment of your P&L statement. In other words, you'll get back a high-level overview of how well are you playing the game of business. In other words, what's your scorecard about your business telling you? As with all videos, I do like to end with a request, and that is I really do enjoy the interaction. So comments, suggestions are welcome. Likes are always appreciated, as well as subscriptions. And here, the teaser for the subscription is the reminder that you go to a football game, you enjoy it because there's score being kept. You play a round of golf and you do remarkably well, you're glad you kept score so you can appreciate what you did well. And in business, your scorecard is right here. This is telling you, as an owner and management team, how well are you doing. So know your P&L statement, use it to make better decisions. Thanks again for tuning in to this edition of Mastering the Math of Business with Lauren Young. See you soon.